Welcome to the channel. I'm James, and today we're going to be looking at Intel Corporation, ticker symbol INTC. We are going to be looking through their earnings as Intel released earnings last night for the year, and then we are going to look at the discounted free cash flow and the Buffett-Graham intrinsic value models to see if this stock is a buy in 2022. But first, let's just have a quick look at the share price. You can see Intel is currently around about $48.72, down 9% on the year. But if we go here, which was the highest point of the year at about $68 a share, it's actually down 28%. So is this a perfect time to get on and buy Intel right now to see if it can get back there? If we just go to the 5-year chart, you can see this is pretty much the highest it's been in the last 5 years. It was $66 before the pandemic, then shot down to $45. So it's only slightly higher than it was at the bottom of the pandemic, which makes it look like it's a great buying opportunity if the stock is fundamentally sound. Intel has a market cap of $200 billion. It's in the the technology sector, and it has a share price of $48.81. It pays a very nice 2.9% dividend, and the ex-dividend date is the 4th of February. So, is the P ratio less than the market? Yes, we'll be touching on a profit in a little bit, but the current P ratio of Intel is 9.5 and the market average is 26.5. So that is a massive, massive pass. Then we'll go on the revenue. Revenue is up. It's gone from 70 billion to 79. So let's take a look at the financials here. You can see that this is the year ended in December 25th, 2021. The net revenue was 79 billion, up from 2020, which was 77.8, and up from 2019, which was 71.9. So revenue is up, but also the cost of sales is up slightly from this time, but the gross margin has increased over those last few years. So that is a pass. Next, what we want to do is look at the profit of Intel and see if that has gone up. And as you can see here, profit has actually gone from 21 billion 5 years ago to 19.8. So that is a fail as per the steps. But if we look here, you can see that operating income is down from those previous years, down from 2020 and 2019. And if we take out everything else, you can see the net income is down. Net income is down slightly. Revenue has increased, but net income is down. So that is a fail. Next, what we're going to be doing is seeing if the shares outstanding are decreasing. And yes, they are. Intel are buying back their shares. If we look here on the document and search what they're doing with shares, you can see that Intel are they're repurchasing shares pretty aggressively. In first quarter of 2021, they repurchased 2.4 billion in shares out of a planned 20 billion that they announced in 2019. And this is basically just keep on going, and they're going to keep on buying back shares for investors, which does reward investors in the long term. Next, what we're going to be looking at is the free cash flow increasing, and no, it's not. 14.2 billion to 11.25. To work out the free cash flow, what we would normally do is take cash from operating activities minus the capital expenditures here, but Intel have kindly provided that calculation already. It's down from 2020, down from 2019, down from 2018, but up from 2017, so that is quite bad. But you can see the net cash flow from operating activities is relatively flat. Yes, it is down from 2020, but that was a higher year. But they've also spent a lot more money on the capital expenditures, additions to property, plants, and equipment. So the next year will be very key to see what happens there. But we want this trending upwards, which it has consistently been. But you can see they've made extra purchases here. So that is a fail. But overall, we have 3 passes and 2 failures, and the free cash flow ratio is the market cap divided by free cash flow. And even with this low number of 11.2 billion, you can see this still gives us a ratio of around about 17, which is still very low. Not as low as the P ratio, but that is a very good number we like to see. And the dividend, they pay about 6 billion in dividend. Is it safe? Yes, it is, 11.2. Now we're going to look at our discounted free cash flow analysis. What I've done here is calculate the future free cash flows based on the revenues and analyst estimates. And even though this is not as bullish as it would be because we are down from 2020, even with 11 billion in free cash flow in 2021, if we extend that out, the company would not be over 2020 in 2025, but this would still give us a calculated stock price of $80 a share, which is a 63% discount. So discounted free cash flow model is saying it is a buy. What we're going to do just quickly is change these numbers a little bit and look at the more recent numbers. So if we say that net income is usually around about We'll take these averages because these are a little bit higher. So that is 83%. That would increase revenue there. Analysts do think it is down in 2022, but you can see it's increasing, so we can keep that the same. And net income margins have decreased as well. But let's just take these as an average right now, and that would be 28.6. This would actually give Intel a calculated stock price of $90 a share. Still not as bullish as it was, or not as much free cash flow as it had in 2020, but you can see that this stock is undervalued based on discounted free cash flow models. So let's just put that back to the original one. And finally, if we look at the Buffett-Graham intrinsic value, this takes earnings per share and expected growth rate into account, and Intel has an earnings per share of $5.16 a share. Expected growth rate is pretty low of 3.6%, but even with that, fair value of $76.47. So both of these models are saying it's a buy, and both of these models are very close together, which is also a very good sign. Right guys, thanks for watching. Please give a like on the video and leave your comments down below, and I'll catch you guys next time.